Have you ever wondered why so many people who spent their entire lives building wealth suddenly find themselves struggling financially just a few years into retirement? You followed every rule in the book. You maxed out your 401k, you diversified your portfolio, and when you hit 60, you dutifully shifted a large portion of your savings into bonds because that's what everyone said was the safe thing to do. Yet here you are, watching your purchasing power erode year after year, wondering if you'll actually be able to maintain the retirement lifestyle you worked 4 decades to achieve. The uncomfortable truth is this: the conventional wisdom about bonds and retirement investing isn't just outdated, it's actively dangerous for anyone over 60 in today's economic environment. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Now think about what happens when you walk into a financial advisor's office at 65. They pull out a colorful pie chart showing you the age-appropriate allocation, maybe 40% bonds, 50% stocks, 10% cash. It looks professional, scientific even. They assure you that bonds are the stable foundation of your retirement portfolio, the safe harbor that will protect you from market volatility. Has this ever happened to you? You nod along, feeling reassured by the presentation, and you hand over your life savings to be managed according to this formula. But here's what nobody in the financial industry wants you to know. This approach was designed for a world that no longer exists. When interest rates were 6%, 8%, or even 10%, bonds made perfect sense for retirees. They provided reliable income and genuine stability. Today's bond market is a completely different beast, and the strategies that worked for your parents' generation could be quietly devastating your financial security right now. Stay with me until the end of this video, because what you're about to discover might completely change how you think about protecting your retirement wealth. The financial services industry has built an entire mythology around bonds being the safe choice for retirees. They've convinced millions of people that reducing stock exposure and increasing bond holdings is the responsible, prudent path as you age. But this one-size-fits-all approach ignores the most critical factors that actually determine whether you'll thrive or merely survive in retirement. The devastating reality is that following this conventional advice perfectly, doing exactly what the experts tell you to do, can still result in watching your retirement savings lose significant value when you need that money most. And unlike when you were 35, with decades of earning potential ahead of you, you don't have the luxury of waiting 10 or 15 years for things to recover. Every year matters. Every decision has immediate consequences for your quality of life. What if everything you've been taught about bonds and retirement investing is actually designed to benefit everyone except you? What if there's a completely different approach that makes far more sense in today's environment, but nobody talks about it because it doesn't generate the steady stream of fees that keeps the financial services machine running smoothly? Let's pull back the curtain on what's really happening behind the scenes with these traditional bond-heavy portfolios that advisors recommend the moment you turn 60. Here's the hidden truth about those allocation models. They're not actually designed to protect your wealth. They're designed to look impressive on quarterly reports while keeping you fully invested, so your advisor continues collecting management fees year after year, regardless of whether you're actually making any money. Think about the psychology behind this for a moment. When you were 30 years old, with decades of earning potential ahead, you could afford to ride out a market crash. You could wait 10 years for your portfolio to recover because you were still working, still contributing, still building. But at 65, on a fixed income, you don't have that luxury anymore. Every dollar matters. Every year counts. Yet somehow, the investment industry is still using the same playbook They used when you were half your age. The financial services world has created an entire mythology around diversification and asset allocation, convincing millions of retirees that if you just spread your money across enough different categories, domestic bonds, international bonds, corporate bonds, government bonds, stocks, real estate funds, commodities, somehow magic will happen and you'll be safe. It sounds sophisticated, it feels responsible, but here's the uncomfortable reality. These predetermined formulas treat every 60-year-old exactly the same way. They don't care if you have $300,000 or $3 million. They don't ask whether you need income starting next month or whether you can comfortably wait 5 years. They certainly don't consider whether bonds are currently offering genuine value or whether you're buying into an overpriced market at exactly the wrong time. This is what I call investing by algorithm, and it's why so many retirees find themselves in financial trouble despite doing everything they were told to do. Your advisor plugs your age into a formula and the computer spits out percentages. 60 years old? Better move 30% into bonds. 65? Make that 40%. 70? Let's go 50%. It's mechanical, impersonal, and completely disconnected from the actual investment landscape you're facing right now. These models don't think. They can't evaluate whether a particular investment makes sense in the current environment. They just follow predetermined rules that were written years ago, possibly decades ago, for economic conditions that no longer exist. If this straight talk resonates with you, make sure you're subscribed. I create content that cuts through the industry nonsense and gives you practical wisdom you can actually use. The transformation in mindset that you need to protect your retirement wealth starts with understanding this fundamental disconnect between what the industry tells you to do and what actually makes sense for your specific situation. Your financial future shouldn't be determined by a one-size-fits-all formula that ignores your individual needs, your risk tolerance, your income requirements, and most importantly, the current state of the markets where your money is actually being invested. Now, I want to go even deeper into why this matters so profoundly for anyone managing retirement savings in today's environment. The decisions you make right now, in this exact moment of your financial journey, will have an impact that echoes through the next 20 or 30 years of your life. Write in the comments, question everything, if you're ready to challenge the conventional wisdom that's been fed to you about bonds and retirement investing. There's a revelation that comes when you start peeling back the layers of how the investment industry actually operates. It's the difference between looking smart and being smart. And understanding this distinction will transform everything about how you approach your retirement wealth. Every single quarter, your fund manager sends you a beautifully designed report showing all the activity in your account. They rebalanced your portfolio to maintain optimal allocation. They shifted 5% from bonds to stocks. They adjusted your international exposure. They tweaked your fixed income holdings. And you're supposed to be impressed by all this sophisticated activity, all these tactical maneuvers being executed on your behalf. But here's what's really happening behind those glossy reports. They're rearranging deck chairs on the Titanic. They're making moves because a computer algorithm told them to, because their investment policy statement requires quarterly rebalancing, because they need to justify their management fees with visible activity. Not because anything genuinely intelligent is being done with your money, not because market conditions have fundamentally changed in a way that demands action, not because they've discovered some hidden opportunity that makes sense for your specific situation. They're just following the script, executing the formula, maintaining appearances. This is where the mindset shift becomes absolutely critical for anyone who's crossed the threshold into retirement. When you were building wealth during your working years, thinking in terms of percentages and allocations made perfect sense. You were dollar cost averaging into the market, contributing regularly from your paycheck, thinking long-term about decades of compound growth ahead. That was accumulation mode, and the strategies that work in accumulation mode are fundamentally sound for that phase of life. But the moment you retire, you've entered a completely different game with completely different rules. You're no longer in accumulation mode, you're in preservation mode. And preservation requires a totally different way of thinking, a different set of priorities, a different approach to risk and opportunity. Yet most financial advisors keep treating you like you're still in your 30s, still building, still playing the long game, as if you have unlimited time and unlimited earning potential ahead of you. The journey toward real financial security in retirement demands that you recognize something the industry desperately doesn't want you to understand. There are times, sometimes lasting months or even years, when the smartest thing you can do with your retirement money is absolutely nothing. When bonds are yielding practically zero, when stocks are trading at absurd valuations, when every asset class seems overpriced and speculative, your allocation model doesn't care. The formula forces you to stay fully invested across all these categories simply because that's what the predetermined percentages demand. You're essentially systematizing stupidity, being forced to buy high simply because an algorithm says you must maintain your target allocation. Think about the impact of this approach on your actual wealth. You're not making intelligent decisions based on value and opportunity. You're making mechanical decisions based on calendar dates and percentage targets. Now, I want to go even deeper into what this means for the specific challenge of bonds in today's environment, because this is where the conventional wisdom becomes most dangerous for retirees who can't afford to lose what they've spent a lifetime building. Put down preservation over percentages. If this resonates with where you are in your financial journey, the transformation in thinking that protects your retirement starts with challenging one of the most deeply ingrained beliefs in all of financial planning. What if I told you that the right allocation for your retirement portfolio right now might be 100% cash? I can almost hear the objections already. But that sounds crazy. But you're not invested, but you're missing out on returns, but inflation will eat away at your purchasing power. Here's the hidden truth that nobody in the financial industry wants you to grasp. Holding cash isn't about being afraid of the market or trying to perfectly time every move. It's about being patient and disciplined enough to wait for genuine opportunities instead of forcing your hard-earned money into overpriced assets simply because some allocation model demands you stay fully invested. Cash isn't lazy money sitting on the sidelines doing nothing. Cash is potential energy. It's optionality. It's power waiting to be deployed at exactly the right moment when the world offers you something that actually makes sense. When bonds are paying you next to nothing and trading at prices that guarantee losses if interest rates rise, holding cash isn't missing an opportunity. Holding cash is the opportunity. You're preserving your capital, maintaining flexibility, and positioning yourself to act decisively when conditions improve. This brings us to another revelation that flies in the face of everything you've been taught about diversification. Some of the most successful long-term investors in history have completely ignored the conventional rules about spreading your money across dozens of different holdings. They've put 70 or 80% of their wealth into just a handful of investments when those specific opportunities made overwhelming sense based on value and fundamentals. They didn't care about looking conventional or fitting into some predetermined allocation model. They cared about actual results, about protecting and growing real wealth in the real world. The journey away from conventional wisdom requires you to question another sacred cow of financial planning, the idea that safety comes from owning a little bit of everything. The financial industry wants you to believe that if you just own enough different things, 50 stocks here, 20 bonds there, some international funds, some real estate trusts, some commodities, sprinkled on top, somehow you'll be protected. And when you look at your quarterly statement with that impressively long list of holdings spanning multiple pages, you do feel sophisticated and diversified and safe. But here's what's really happening behind that complexity, and this is where most retirees make their biggest mistake. You don't truly understand a single thing you own. You can't explain what these companies actually do, how they make money, what competitive advantages they have, what threatens their business model, or why you should own them instead of something else. You're just trusting that because your portfolio is diversified across many categories, everything will somehow work out. You've outsourced all the thinking to a formula and hoped for the best. The impact of this approach becomes devastating when markets turn against you because you have no framework for making intelligent decisions. Should you buy more? Should you sell? Should you hold? You don't know because you never really understood what you owned in the first place. Now, I want to go even deeper into why this matters so profoundly for retirees specifically, because when you're living off these investments rather than just accumulating them, everything changes. Write in the comments, "I want to understand," if you're ready to take back control of your financial decisions. The revelation that changes everything about retirement investing is this. When you deeply understand 3 or 4 investments, when you know exactly why you own them, what specific risks they face, what competitive advantages they possess, and what circumstances would make you sell, you're actually far safer than owning 30 or 40 things you can barely name. This isn't reckless concentration, this is intelligent focus, and there's a massive difference between the two. Quality over quantity becomes your guiding principle, especially when you're depending on these investments for your actual living. Expenses every single month. Think about the transformation that happens in your decision-making when you truly know what you own. If one of your holdings drops 20% in value, you're not panicking because you understand whether that decline represents a genuine problem with the business or just temporary market noise. You can make informed decisions about whether to buy more at a better price, hold steady, or exit the position entirely. But when you own dozens of things, you don't. Understand, every market movement feels like chaos, and you're completely dependent on someone else to tell you what to do. If you found value here, hit that like button. It helps this message reach others who need to hear it. Here's where the mindset shift becomes powerful. The moment you start following rigid allocation frameworks and predetermined formulas, you've surrendered the most valuable asset you have. Not your money, your independent judgment. Those algorithms and models can't think. They can't evaluate whether a particular investment makes sense right now in the current environment with current valuations and current economic conditions. They just mechanically execute rules that were programmed into them, often years ago by people who don't know you and will never feel the consequences of being wrong. But you have something far more valuable than any computer model. You have the ability to look at a specific situation and decide whether it's intelligent or stupid. You can say no when something doesn't make sense, regardless of what category it falls into or what allocation percentage some formula says you should have. You can recognize when the emperor has no clothes, when everyone's chasing the same overpriced asset, when the risk-reward equation just doesn't add up. No algorithm will ever match disciplined human judgment that knows when to act and, crucially, when to walk away. The journey toward true financial security in retirement brings with it a form of clarity that most people never experience during their working years. When it's your own money at risk, money you absolutely cannot replace because you're no longer earning a regular paycheck, everything changes. The way you think becomes sharper. Your natural conservatism isn't born from fear, but from wisdom. You develop an almost instinctive sense of self-preservation that forces you to ask hard questions before making any move with your capital. This personal accountability creates a completely different decision-making process. You stop making moves just to feel active or to keep up with what everyone else is doing. You only act when the odds are so overwhelmingly in your favor that passing up the opportunity would actually be the real mistake. Every decision gets filtered through the lens of genuine necessity rather than abstract portfolio theory. Now, I want to go even deeper into where this wisdom leads you when it comes to the specific question of bonds and fixed income in today's environment, because this is where personal accountability reveals truths that the financial industry desperately wants to keep hidden. Put down my money, my decisions, if you're ready to trust your own judgment over someone else's formula. Let me pull back the curtain on something that's happening to your retirement savings right now. Something so embedded in the system that most people never even notice it until years of wealth have quietly disappeared. Every single quarter, money is silently vanishing from your account, not because of market losses, not because you made bad investment decisions, but because of fees, management fees, advisory fees, fund expense ratios, transaction costs, administrative charges. And here's the truly insidious part. These fees get paid whether your account goes up, down, or sideways. Whether you made money this year or lost 30%, your financial advisor still gets their cut. It's perhaps the most brilliant business model ever created for the people collecting those fees, but it's absolutely devastating for retirees who are watching their wealth slowly erode. Think about the psychology behind this arrangement for a moment. When someone gets paid the exact same amount whether you succeed or fail, where's their genuine incentive to treat your money like it's their own? If your advisor makes a mistake and your bond portfolio drops significantly because interest rates moved against you, they're not lying awake at night worrying about how they'll pay their bills. They're not scrambling to figure out how to recover those losses. They simply write you a professionally worded letter explaining that what you experienced was normal market volatility or temporary underperformance or some other sanitized phrase that sounds sophisticated, but really just means they lost your money. And then next quarter, they collect the same fee they always did. This is the hidden truth about how most retirement wealth gets slowly bled away. Not through dramatic market crashes that make headlines, but through the steady, relentless drip of fees attached to mediocre performance. The transformation that needs to happen in your mindset is understanding that when you take control of your own financial decisions, there's no place to hide from reality. You can't blame the algorithm. You can't point to some benchmark and claim you beat it by 0.5% while still losing actual money. You either made intelligent decisions that protected and grew your wealth, or you didn't. That accountability, that direct feedback is precisely what you need when managing money you absolutely cannot afford to lose. The impact of getting this wrong becomes profoundly different after 60 compared to when you were younger. During your working years, if your portfolio underperformed or your advisor made questionable decisions, the consequences were relatively manageable. Maybe it meant you had to work until 67 instead of retiring at 65. Annoying, certainly, but you could absorb that setback because you were still earning income, still contributing to your accounts, still building toward the future. After retirement, the stakes transform completely. Bad performance doesn't just delay your plans. It can mean fundamentally altering your lifestyle, cutting back on essentials, or facing the terrifying prospect of running out of money entirely while you're still alive with no way to earn it back. Yet somehow, most people are still using the same investment approach, the same allocation strategies, the same bond-heavy portfolios they were using at 40. The journey toward real financial security demands that you recognize how different the game has become. Now, I want to go even deeper into what this means specifically for the role of bonds in a retirement portfolio, because this is where the conventional wisdom becomes most dangerous and where making the wrong decision carries consequences you simply cannot afford. Type, stakes are different now if you're starting to see why the traditional approach to bonds after 60 needs to be completely rethought. The revelation that transforms how you think about managing retirement wealth is understanding where true advantage actually comes from. It's not about having the highest IQ or access to the most sophisticated financial models or knowing some secret strategy that nobody else knows. The biggest advantage in investing is having your interests completely and totally aligned with the person making decisions about your money. When someone's personal wealth rises and falls with yours, when they feel the pain of losses and the satisfaction of gains in exactly the same way you do, they protect capital like it's their own. Because it is their own. This alignment is worth more than all the fancy degrees and professional certifications combined. Yet it's the one thing that traditional advisory relationships completely lack. Your advisor's income stays the same, whether you thrive or struggle. Their mortgage payment doesn't depend on whether they made you money this quarter. Their retirement isn't at risk when they recommend moving a significant portion of your savings into bonds that might not serve your best interests. The journey toward genuine financial security means either finding this alignment with someone whose compensation is directly tied to your actual results, or taking control yourself, where the alignment is automatic and perfect. Here's where understanding the system reveals something that will change how you view every recommendation that comes your way. The entire financial services industry is fundamentally built around movement and activity. Every trade your advisor executes generates transaction costs. Every quarterly rebalancing creates activity and justifies fees. Every new bond fund or investment product that launches comes with layers of expenses attached. And you're supposed to feel like you're getting value from all this motion, all these tactical adjustments, all these sophisticated maneuvers being executed on your behalf. But the hidden truth is that all that motion, all that constant activity, isn't compounding your wealth. It's compounding their fees. The more they do, the more money flows out of your account and into the financial services machine. This is why patience and selectivity become such powerful advantages when you manage your own retirement money. You're not incentivized to create activity for its own sake. You're incentivized to make genuinely intelligent decisions and do nothing the rest of the time. The transformation in thinking that protects retirement wealth is recognizing that the strategies which made sense when you were younger have to be completely inverted. When you were building your career in your 30s and 40s, being proactive made perfect sense. Take action, make moves, stay busy, seize opportunities. That aggressive, forward-leaning approach was appropriate for someone with decades of earning potential ahead. But with your retirement savings, the opposite becomes true. You need careful, deliberate decisions that prioritize one thing above all else, not losing money. Notice I didn't say making money or maximizing returns or beating some benchmark. After 60, preservation becomes infinitely more important than growth. And this isn't being timid or fearful. It's being mathematically realistic. A 30% loss doesn't just mean you need a 30% gain to recover. You need a 43% gain just to break even. When you're living off your savings rather than adding to them, that math becomes brutal. Now, I want to go even deeper into why this preservation mindset completely changes how you should think about bonds specifically, because the traditional reasoning for holding them falls apart once you understand what's really at stake with your retirement capital. Write in the comments, preservation first, if this resonates with where you are on your financial journey. There's a dangerous seduction that happens in the financial world, especially when traditional bonds aren't delivering the returns people feel they need. The industry starts dressing up risky strategies in sophisticated language designed to make them sound prudent and scientific. You'll hear phrases like optimizing returns or efficient capital deployment or enhanced yield strategies when advisors recommend leveraged bond funds or margin accounts or complex derivatives. But strip away all that impressive jargon and here's what leverage actually is: borrowing money to make bigger bets with your retirement savings. The transformation you need to understand is that leverage doesn't just amplify your gains when you're right. It transforms small mistakes into catastrophic losses. You might make the right call 9 times in a row, feeling like a genius, congratulating yourself on your sophisticated strategy. And then on the 10th time, the market moves against you in a way you didn't anticipate, and suddenly you're not just losing your gains. You're losing your original capital, the money you spent 40 years accumulating. For someone over 60, there's simply no recovering from that kind of setback because there's no time left to rebuild. This is where the mindset shift becomes absolutely critical for retirement investing. Your goal isn't to maximize every single opportunity that presents itself. Your goal isn't to squeeze out every possible percentage point of return. Your goal is to avoid permanent capital loss. That's it. That's the entire game after 60. Being occasionally boring, holding cash when everyone else is chasing the latest high-yield bond fund, owning simple, straightforward investments when others are getting clever with complex strategies, all of that beats being occasionally bankrupt. Because bankruptcy at 65 doesn't mean starting over with a fresh perspective and new determination. It means your retirement is over. The journey toward real financial security requires you to completely redefine what courage actually looks like with money. The financial media loves celebrating the bold risk-takers, the ones making aggressive bets and swinging for the fences. They profile the investors who went all in on some contrarian position and made a fortune. But that's not courage. That's just gambling dressed up in a nice suit and presented with confident language. Real courage, the kind that actually preserves retirement wealth through decades of market cycles, looks completely different. Real courage is having the emotional stability to stand absolutely still when everyone around you is either panicking or getting wildly greedy. It's watching your neighbors brag about the returns they're getting from their high-yield bond funds or their leveraged strategies and calmly saying to yourself, "No, that doesn't make sense for me. I don't need to chase that." That kind of quiet strength, that willingness to look boring or even foolish in the short term while others are celebrating their gains, becomes your most valuable asset after 60. The impact of this patient, disciplined approach might not show up in next quarter's performance report, but it shows up when the market eventually turns, when those aggressive strategies blow up, when the people who were bragging 6 months ago are now scrambling to figure out how to recover their losses. You're still standing, still solvent, still able to pay your bills and maintain your lifestyle. Now, I want to go even deeper into what this means specifically for how you should think about bonds and fixed income, because this is where patience and discipline create the most profound advantages for retirees who understand the game they're actually playing. Put down patient strength if you're ready to embrace the kind of courage that actually protects retirement wealth. There's a concept that's been weaponized against retirees, twisted from its original purpose into something that actually undermines your financial security rather than protecting it. The financial industry has convinced millions of people that safety comes from owning as many different things as possible: 50 different stocks, 20 different bond funds, international exposure, emerging markets, real estate trusts, commodities. The more categories you check off, the safer you supposedly are. But here's the hidden truth that changes everything. Owning 50 mediocre businesses or 20 mediocre bond funds doesn't actually protect you. It guarantees mediocrity. You haven't diversified your wealth. You've diversified your ignorance instead of concentrating your knowledge where it can actually do some good. The transformation that needs to happen in your thinking starts with an honest question that most people never ask themselves. Can you actually understand 20 to 50 different businesses or bond issuers? Not just recognize the names, but genuinely understand how they operate, what drives their profitability, what threatens their ability to pay you back, what makes them worth owning instead of something else. For most people, if we're being brutally honest, the answer is no. Maybe you can truly understand 3 or 4 companies or investment opportunities if you really study them. Dedicate time to learning their fundamentals, follow their progress over time. The mindset shift that protects your retirement is accepting that your circle of competence has real limits, and that's not a weakness, that's wisdom. After 60, pretending to understand investments you don't is far more dangerous than concentrating your wealth in the few opportunities you genuinely do understand. When you deeply know something, how it makes money, what threatens it, why it's priced the way it is, you can make intelligent decisions about when to add more, when to hold steady, and when to walk away. But when you own 20 bond funds, just because your allocation model said you needed fixed income exposure across different categories, you're flying completely blind. This brings us to something that sounds radical, but represents one of the most important revelations in retirement investing. There's a massive difference between recklessness and conviction, and understanding this distinction will transform how you think about concentration versus diversification. Imagine putting a significant portion of your net worth into just a handful of carefully selected investments during a period when you found genuinely screaming bargains, opportunities so obvious they felt almost too good to be true. Most financial advisors would have an absolute heart attack if you suggested this. They'd warn you about concentration risk and the dangers of putting too many eggs in one basket and the importance of maintaining your allocation targets. But here's the revelation. If you deeply understood what you were buying, if you'd done the real work to know these investments inside and out, that's not recklessness. That's calculated conviction based on actual knowledge. There's an enormous difference between gambling on things you don't understand and committing capital to opportunities you've thoroughly researched and comprehend at a deep level. The journey toward financial security in retirement means developing the confidence to act on genuine conviction when you find something that truly makes sense, rather than spreading yourself thin across dozens of mediocre options just to satisfy some arbitrary diversification rule. Now, I want to go even deeper into how this applies specifically to bonds and fixed income, because this is where the conventional diversification wisdom becomes most dangerous for retirees who need actual results rather than theoretical protection. Type knowledge over spread if you're starting to see why. Understanding a few things deeply beats owning many things superficially. There's something fascinating that happens when you've lived through 6 or 7 decades of market cycles, economic shifts, and financial upheavals. You develop an intuition that younger investors simply cannot possess, no matter how smart they are or how many books they've read. You understand something profound about where genuine value actually hides. It doesn't announce itself with fireworks and headlines. It doesn't show up in the latest hot investment trend that everyone's talking about. Real value hides in boring places that everyone else ignores, in unfashionable industries that younger investors dismiss as outdated or irrelevant, during moments of panic when everyone's running for the exits and nobody wants to hear about opportunity. Being over 60 gives you an enormous edge that you need to recognize and leverage. You've lived through enough cycles to see the patterns repeat. You've watched panic turn into profit. You've seen today's disaster become tomorrow's opportunity. This experience, this perspective that only comes with decades of actually living through market history rather than just reading about it, is worth more than any sophisticated algorithm or mathematical model. The transformation in thinking is recognizing that your age isn't a disadvantage in investing. It's actually your secret weapon if you know how to use it. But here's where most retirees get derailed from using this wisdom effectively. They get caught up in a game that has nothing to do with their actual financial security. Your financial advisor sends you a report showing that your bond portfolio beat some benchmark by 0.3% this year. They're proud. They want you to see the value they're adding. But let's think about what this actually means. If you lost 15% while the market lost 15.3%, you still lost money. Congratulations, you drove slightly. Slower than everyone else on the way off the cliff. Does that make you feel better? Does that pay your bills? The journey toward real financial security requires you to completely abandon this benchmark game that the industry wants you to play. When you're living off your savings, when you're depending on this money for your actual daily expenses, it doesn't matter one bit whether you beat some arbitrary index if your account value is dropping. You can't pay your mortgage with relative performance. You can't buy groceries with bragging rights about outperforming a benchmark by a fraction of a percent. What matters? The only thing that actually matters is whether your wealth is growing in real dollar terms or at absolute minimum staying stable enough to support your lifestyle without forcing you to make painful compromises. This shift from comparing yourself to indexes and benchmarks to focusing on your actual financial reality is one of the most liberating changes you can make in retirement. You stop caring about what some bond index did. You stop worrying about whether you're matching or beating market returns. You start asking the only questions that truly matter. Can I maintain my lifestyle? Is my wealth secure? Am I making decisions that protect what I've built? The impact of this mindset transformation is profound because suddenly you're free from the pressure to chase returns or match performance targets that have nothing to do with your real needs. Now, I want to go even deeper into what this means for the specific decisions you make about bonds and fixed income. Because this is where abandoning the benchmark game and focusing on absolute results reveals strategies that most retirees never even consider. Write in the comments, real dollars matter, if you're ready to stop playing Wall Street's comparison game and start focusing on what actually protects your retirement. There's a paradox in successful retirement investing that seems contradictory on the surface, but actually represents profound wisdom once you understand it. You need to be both completely consistent in your core principles and entirely flexible in your specific tactics. Think about what this actually means in practice. Some of the most successful long-term investors in history have owned radically different types of assets during different periods of their lives. All stocks during one decade when equities offered genuine value, then mostly bonds or cash in another period, when fixed income actually made sense, then back to equities when market conditions shifted again and opportunities reappeared. That's not inconsistency. That's not changing your mind every time the wind blows. That's intelligent adaptability. They're not abandoning their core philosophy, which is always to go where genuine value exists and avoid overpriced garbage, regardless of what category it falls into. They're simply recognizing that value moves around. After 60, This ability to adjust your approach as conditions change becomes absolutely essential for survival. Being rigidly stuck in one strategy just because it worked 5 years ago, or because some allocation rule says you should own a certain percentage of bonds, is how people get financially crushed. The journey toward financial security and retirement requires you to understand another hidden advantage that almost nobody talks about. When you become predictable in your investment patterns, when everyone knows you'll be buying bonds on a regular schedule or rebalancing at certain predetermined times, you become exploitable. Not through some conspiracy, but simply through the natural mechanics of how markets work. If everyone knows that millions of retirees will be buying fixed income every December for year-end rebalancing, guess when bond prices tend to rise and yields compress? The market watches for these patterns and adjusts accordingly. The transformation in thinking is maintaining some unpredictability in your approach. You're not mechanically following a calendar or a formula that anyone can anticipate. You're not telegraphing your moves quarters in advance. You go where genuine opportunity exists when it exists, not when some predetermined schedule says you should. You buy when prices make sense, not when a rebalancing algorithm demands it. This flexibility isn't about being random or impulsive. It's about not being a robot that sophisticated market participants can anticipate and profit from. Now here's where everything we've discussed comes together into a practical approach that completely inverts conventional portfolio wisdom. Portfolios don't actually win through perfect balance and careful allocation across multiple asset classes. They win through what I call decisive imbalance. When you find something that genuinely makes sense, when the risk-reward equation is so obviously in your favor that you'd have to be asleep to miss it, that's when you need to act meaningfully. Not timidly putting 2% of your portfolio into it, actually committing enough capital that it matters if you're right. And here's the other side of that equation that's equally important. When nothing makes sense, when bonds are yielding nothing, and stocks are overpriced and every asset class seems stretched, you do absolutely nothing. You hold cash, you wait. You preserve your capital for when genuine opportunities present themselves. The impact of this approach, this rhythm of concentrated, decisive action, followed by extended periods of patient inaction, might look strange to advisors trained in modern portfolio theory, but it's exactly what protects retirement wealth in the real world, where you can't afford the luxury of theoretical diversification that doesn't actually serve your needs. Now, I want to go even deeper into what this means specifically for bonds, because this is where decisive imbalance reveals opportunities that the conventional allocation approach completely misses. Put down, act when it counts, if you're ready to embrace this more selective, more intentional approach to retirement investing. There's something powerful you've earned through decades of work that you might not even recognize as an advantage. You've spent 40 or 50 years building your career, raising your family, accumulating wealth through consistent effort and discipline. You've proven yourself countless times. You've met deadlines, satisfied bosses, delivered results, navigated office politics, and climbed whatever ladder you chose to climb. And now you've earned the right to be patient. You don't need to prove anything to anyone anymore. You're not competing with colleagues for the next promotion. You're not trying to impress some committee with your quarterly performance. This freedom from external pressure is an enormous advantage in retirement investing, but only if you actually leverage it instead of squandering it by acting like you're still in accumulation mode. The transformation in mindset that protects retirement wealth is understanding what patience actually accomplishes in financial markets. There's a principle that operates with mathematical certainty across every market cycle. Wealth transfers from the impatient to the patient. Every single day, somewhere in the market, someone is panicking and selling at exactly the wrong time because they can't handle watching their account balance fluctuate. Someone else is getting greedy and buying at too Inflated prices because they can't stand the feeling of missing out while everyone else seems to be making money. Someone is making a move just because they're bored and feel like doing nothing is somehow failing. All of that restless energy, all of that impatience, all of those emotionally driven decisions create opportunities for those who can simply sit still and wait. The journey toward financial security after 60 means recognizing that you're no longer playing the game most people are playing. You're not trying to capture every market move or participate in every rally or avoid every temporary decline. You're waiting for situations where the odds are so overwhelmingly in your favor that acting becomes the obvious choice and passing becomes the actual risk. This brings us to perhaps the most counterintuitive insight in all of retirement investing, something that goes against every instinct the financial industry has trained into you. When there are no good opportunities visible in the market, when bonds are offering minimal yields that don't justify their risks, when stocks are priced for perfection, when every asset class seems expensive relative to historical norms, the most profitable action you can take is inaction. Not paralysis born from confusion or fear, strategic inaction born from discipline and wisdom. Patience in these periods literally preserves your capital, keeping it safe and available for when genuine opportunities inevitably present themselves. Markets cycle, they always have. Periods of overvaluation eventually give way to periods of undervaluation. Times when everything seems expensive eventually transition into times when genuine bargains appear. Having the wisdom to recognize this distinction, to understand when you should be acting versus when you should be waiting, separates retirees who thrive financially from those who merely survive by watching their wealth slowly erode through poor timing and forced participation. In overpriced markets, the impact of embracing strategic patience becomes especially profound when you apply it to the specific question of bonds in your retirement portfolio. Most allocation models force you to maintain significant fixed income exposure regardless of whether bonds currently offer any real value or protection. They keep you invested because that's what the formula demands, even during periods when patience and cash would serve you far better. Now, I want to go even deeper into what this patient, selective approach means for how you should actually think about bonds after 60, because this is where conventional wisdom and practical reality diverge most dramatically. Type patient capital wins. If you're starting to see how waiting for genuine opportunities beats following predetermined formulas that force you to act regardless of market conditions. There's a perfect analogy from baseball that captures the essence of intelligent retirement investing in a way that completely transforms how you think about opportunity and action. When you're at bat in baseball, you have to swing at pitches that come through the strike zone, or the umpire calls strikes against you. 3 strikes and you're out. The game forces you to participate even when the pitch isn't ideal. But investing operates under completely different rules, and understanding this difference changes everything about how you manage retirement money. In investing, there are no called strikes. You can stand there and watch pitch after pitch go by. Bad opportunities that don't make sense, mediocre opportunities that might work but don't offer compelling odds, overpriced bonds yielding almost nothing, speculative investments everyone's excited about but that don't fit your needs. You can let all of them pass without consequence. Nothing happens. You're not penalized for patience. You're not forced out of the game for being selective. And then eventually, sometimes after waiting months or even years, a pitch comes right down the middle of the plate. So perfect, so obviously in your favor, that even someone with average investing skills can knock it out of the park. The transformation in mindset is recognizing that your job isn't to swing at every pitch. Your job is to wait for the ones that are unmistakably good. This brings us back to something we touched on earlier, but needs to be explored even deeper because it represents such a radical departure from conventional advice. The financial industry has spent decades convincing everyone that cash sitting in your account is a drag on performance, that it's lazy capital that should be put to work immediately generating returns. But that entire narrative serves their interests, not yours. Cash isn't a burden. Cash is optionality. It's power waiting to be deployed when circumstances warrant it. During market downturns, when bond prices are falling and everyone who's fully invested is paralyzed watching their account values drop, the person holding cash has something invaluable: choices. They can act when others are forced to sit tight or sell at the worst possible time. They can take advantage of genuine bargains that appear during panic while everyone else is scrambling just to preserve what they have left. The journey toward real financial security in retirement demands that you develop a skill most people never acquire because it feels so uncomfortable. You need to embrace boredom, actually learn to love it. Because here's the hidden truth about how most retirement portfolios actually die. Not from ignorance, not from bad luck, but from pure boredom. The investor couldn't tolerate the discomfort of holding cash for months or years during a period when nothing genuinely made sense. So they invested in something that sort of made sense, something that seemed reasonable enough just to feel like they were doing something productive. That's when the slow erosion begins. That's when you start buying mediocre bonds at mediocre yields in mediocre market conditions, simply because sitting still felt too passive. Learning to embrace those boring periods, to actually see them as opportunities rather than problems, becomes one of your greatest competitive advantages after 60. There's another analogy that perfectly captures this selective approach to retirement investing. Professional poker players understand something fundamental about winning over the long term. They don't win by playing every hand dealt to them, by participating in every pot, by constantly being in action. They fold the vast majority of hands, sometimes 99 out of 100, and only bet meaningfully when they have a genuinely strong position where the odds clearly favor them. This same selective discipline is absolutely essential for retirement investing when you can't afford to lose. Your job isn't to play every opportunity that presents itself. Your job isn't to maintain constant exposure to bonds just because conventional wisdom says you should. Your job is to recognize those rare situations where the odds are so overwhelmingly in your favor that not acting would actually be the real mistake. Now, I want to go even deeper into what this selective, patient approach means, specifically for bonds, and how it leads to a completely different strategy than what most financial advisors will ever tell you. Write in the comments, selective beats active, if this approach to retirement investing resonates with how you want to protect the wealth you've spent decades building. If you've made it this far in the video, you're clearly someone who thinks differently about money and retirement than most people. You're not looking for quick fixes or the latest investment fad that everyone's talking about. You understand that protecting wealth after 60 requires a completely different mindset than building it in your 30s and 40s. And that awareness, that willingness to question conventional wisdom and think independently about what actually makes sense for your situation, is exactly what separates retirees who thrive from those who struggle. Everything we've talked about today, from questioning the traditional role of bonds in retirement portfolios to embracing strategic patience instead of forced activity, these aren't just theoretical concepts. They're practical approaches that have protected wealth for some of the most successful long-term investors in history. The question is whether you're ready to apply them to your own situation, to stop following formulas that were never designed for your actual needs, and start thinking like an owner of your financial future. If this conversation resonated with you, If you found yourself nodding along and thinking that finally someone's being honest about retirement investing without the industry spin, then go ahead and subscribe to the channel. I create content like this regularly because I believe people who've worked their entire lives to build what they have deserve. Straight talk about money. No hype, no product pitches, just practical wisdom you can actually use to make better decisions. And leave a comment saying, "This message was meant for me, so I know you made it all the way through." I read every single comment, and it helps me understand what's connecting with people who are on this same journey towards smarter retirement investing. Your engagement also helps this message reach others who need to hear it. People who are tired of conventional advice that serves everyone except them. If you found value in what we discussed today, hit that like button. It costs you nothing, but it genuinely helps this content find its way to the people who need it most. Now, there's a video right here that takes what we discussed today even further, showing you exactly how to think about alternative strategies when traditional bond allocations don't make sense anymore. Click and continue with me over there, because what we've covered today is just the beginning of thinking differently about your financial future.